And it is estimated that at the peak of gold's market share, which was 1971, that the corresponding number was over 6%. So I'm not suggesting that gold will conquer the treasury market. I'm only suggesting that because long bonds represent return-free risk, a guaranteed loss, that enough money will flow out of long bonds into gold that gold's market share will revert to mean. I think the most serious determinant of the gold price is the level of negative real interest rates around U.S. Treasury securities. The most important savings and investment product in the world is the U.S. 10-year Treasury. It's the security that all other securities are priced against. Currently, the arithmetic around the U.S. 10-year Treasury is that it yields you about 3.5% in a currency that the Congressional Budget Office acknowledges is costing you between 7 and 7.5% in purchasing power a year, which is to say that right now, the most important competitor for gold guarantees you a 3.5% annual loss of purchasing power. That's very good for gold over time, and very hard, by the way, on U.S. dollar-denominated savers, to the extent that the Fed was actually successful in engineering a soft landing, which is to say, to the extent that they could keep the interest rate on the U.S. 10-year Treasury at, say, 3.5 or 4, while reducing the rate of inflation to 2, so that the U.S. 10-year Treasury had a positive yield, that would be very bad for the gold price. I would tell the questioner that a circumstance where the nominal interest rate exceeds the CPI stated rate of inflation, and I don't want to get into arguments about the CPI. I don't believe in it either, but the market psychology does. So to the extent that nominal interest rates became real interest rates, gold would have a hard time. If the questioner believes that Congress will balance the budget, then I think you need to be concerned about the gold price. Understand that you are probably only then postponing a gold price increase, because if one assumes that they balance the nominal budget, we still have at the federal level over $100 trillion in recourse liabilities off balance sheet for entitlements: Medicare, Medicaid, veterans benefits, Social Security Trust Fund, federal pensions. But those liabilities in investors' minds are liabilities that they incur in the future, 7 years from now, 8 years from now, where the nominal interest rates became real. And the predecessor to that, of course, would be balancing the budget. Then I think gold investors need to be concerned. Well, certainly one of the things that I think has helped gold demand in the last 3 years has been the U.S. government's policy of weaponizing the dollar. The U.S. dollar is still the world's medium of exchange and form of settlement. And the largest asset class for domestic and foreign savers in the world is still the U.S. Treasury market. The United States government has done its very best to debase the franchise that the U.S. dollar enjoys, weaponizing the dollar and at the same time weaponizing the SWIFT banking system. The consequence of that is that other countries and other cultures who don't like the extraterritorial imposition of U.S. policy have begun to store large amounts of gold, with the view both to affecting trade settlements between them and non-U.S. trade parties in gold as opposed to in the dollar, and also because of the value proposition offered up by U.S. Treasuries. Imagine yourself running the Chinese central bank. Imagine that you're sitting on a pile of $2 trillion of U.S. Treasuries. Imagine, first of all, that you understand that the U.S. government is weaponizing the dollar against you in China, while understanding, too, that the U.S. government is paying you 3.5% in a currency where the purchasing power is falling by 7%. Why would you subsidize somebody who is acting like an avowed enemy? You understand that the weaponization of the U.S. dollar and the lousy investment characteristics of U.S. 10-year treasuries mean that increasingly geopolitical considerations are important in the gold markets. I personally believe that the next phase of the gold bull market will be kicked off by a disintermediation out of long bonds into gold. Most of the extraordinarily large pools of capital, sovereign wealth funds, pension services, university endowments, are very, very, very long-dated bonds. And for 40 years, that strategy worked for them. As the interest rate fell, the capitalized value of the distributions that they were already enjoying increased. And we had a period of relatively low inflation. That party has changed after 40 years. We have a circumstance now where if you have a 30-year bond in your portfolio that you picked up 2 years ago, the capitalized value of your distributions at 1.5% is half. Now that the prevailing worldwide interest rate on a 10-year is 35 basis points. So the principal value of your pension plan has fallen at the same time that the relatively low interest rates that you receive relative to the depreciation of your currency means that the distributions that you will be able to make to your pension holders 20 years from now will buy substantially less than they hope that you would buy. You are truly, as the manager of a very large pension fund, between a rock and a hard place. The capitalized value of your distributions goes down, meaning that your principal goes down. The contributors to the scheme, be they taxpayers or pensioners, don't want to make up the shortfall to the principal. In other words, they don't want to save more now to invest later. And as a consequence of inflation, the purchasing power that beneficiaries are counting on receiving 20 years from now or 25 years from now are being wounded, perhaps mortally, today. Old habits die hard. Pension fund managers have done very well for 40 years owning long bonds. And two, there are statutory incentives for them to do that. If you are a very large pension fund, actuarial rules allow actuarial fraud. If you suggest as a portfolio manager that you own a long bond which you're going to hold to maturity, in most countries, the laws allow you to refrain from marking that bond to market. Because you intend to hold it to maturity, they allow you on a sovereign instrument in particular to carry that bond at par. And I believe that you will see an increasing trend worldwide for pension fund managers, large endowment managers, to de-emphasize long bonds, which are currently an important part of their investment portfolio. I don't expect to see all of this money flow into gold, but I expect to see enough of it flow into gold to have a dramatic increase in impact on the price. And here's why. The market share of precious metals and precious metals related securities, just in the United States, relative to all the savings and investment assets in the United States, is less than 0.5%. The 4-decade mean is 2%. And it is estimated that at the peak of gold's market share, which was 1971, that the corresponding number was over 6%. So I'm not suggesting that gold will conquer the treasury market. I'm only suggesting that because long bonds represent return-free risk, a guaranteed loss, that enough money will flow out of long bonds into gold that gold's market share will revert to mean. If gold's market share reverted to mean, which is to say 2%, compared to 0.5%, demand for precious metals and precious metal securities in the United States market, the largest savings and investment market in the world, would quadruple. And that's what I think is going to happen.